Good evening, folks. All right, so we're looking at a daily chart of the E-mini S&P June delivery contract month for 2023. And I'm going to cover the market that we saw delivered today on ES. So when I do these kind of lectures, invariably, people will leave comments when I allow the comment section to be open. They'll flood it with great, love it, it's a sugar high. Invariably, there'll also be a sprinkling of maybe 4 or 5 people that'll come in. They'll say things like, you talk too much, get to the point, that type of thing. And the markets are so technical, and especially if you're a student of mine, you realize that there are many subtleties that are glossed over when you first look at my studies or go through my lectures. And then when you go through it the second time or third time, it begins to resonate with you more because now you have more experience. And those things are now much more impactful in your understanding and your ability to read price action. So it's my endeavor really to try to convince you to seek out the details. Get comfortable with digging into all the very specific things that I'm sharing, because I don't talk just to hear my own voice. I'm telling you things that are paramount for you to understand precision, algorithmic principles that these markets deliver under, and the repeating phenomenon that exists through time and price. So with that spirit in mind, I want you to watch the following and take notes. All right, so the daily chart here we've mentioned in commentary on tweets and in passing in little video clips on Twitter. And my long-term students understand that I follow seasonal tendencies from a macro perspective. That means from a daily and weekly time frame. And there are certain times of the year that I like certain setups to form. In May of every calendar year, in May going into the first and second week of June, I favor shorts in stock index futures. Now, over the years, it's grown into a expression. Usually you see it as sell in May and go away. So it's kind of like an expectation that in spring, there's a usual, not always, usual tendency for stock prices to descend going into June. I've been following the markets for 3 decades. And I can tell you there are certain seasonal tendencies that are just really, really strong. And one of them is this May influence going into June. So if you are looking for a way to dial in a very specific time of year to look to be a trader or learn to be anticipating specific things in price action, there's no better one than being bearish in spring going into the summer months, and then being long in the fall months going into the end of the year, first week of February. So that tendency is not just being mentioned here. If you go on my core content lessons that I've uploaded here on YouTube, you'll hear me talk about those very things, and they keep repeating every single year. I first taught about it in 2016 in the core content lectures that paid members were listening to me teach. And the same thing verbatim repeats every single year. So in 2016, I released that content to paid members. 2017, it repeated in the marketplace. In 2018, it repeated. In 2019, it repeated. In 2020, it repeated. In 2021, it repeated. 2022, it repeated. And it's probably going to repeat again this year too. Okay? Don't be limited to just thinking it only works in the last few years. Go back as far as you can, studying old data. You'll see that they're pretty much a higher time frame roadmap for where significant price moves will form. Now, by themselves, they're not a panacea. It's not a be-all, end-all type thing where just because seasonally it's done this in the past, because the futures market are not guaranteed to deliver based on past performance. So that's why we have a risk disclaimer every time we're meeting together. But if you know that there's a strong tendency for things to repeat more times than not over many years, not just a handful of years, to me, it warrants a little bit more investigation, a little bit more concern, and study in that area, in that specific time of the year. And I'm confident that you'll find that there's a gold mine in this, okay? You have to add some technicals to it too. Okay, we're going to talk a little bit about that now. Admittedly, going into this, I want you to remind yourself that it is non-farm payroll week at the time of this recording. That means tomorrow it'll be non-farm payroll Friday, or May 5th, 2023. We've already started trading for that day here, but in my local area, as you can see, it's not even the 5th yet, but it's being calculated for that candle here on TradingView. So I want you to look at how we have had this high here. It traded above it, created a swing high, which is a candle with a high, with a lower high to the left of it and a lower high to the right of it. Then when we see that, we anticipate price to try to drop going lower. It does. It goes below this swing low, which is a low that has a higher low to the left and a higher low to the right. It goes down below that into this inefficiency here, which is a buy-side imbalance, sell-side inefficiency, which is a classification for a specific fair value gap. Market trades down into that, creates a swing low, then rallies back up, swings above this swing high. So above this swing high is buy side, below this swing low is sell side, above this swing high is buy side, below this low is sell side. So we've had a high, low, higher, low, higher high, lower low. See that? So in classical price pattern formation, which I'm not a price pattern trader in the sense I look at things from a retail perspective, but this would be considered a broadening pattern or a megaphone pattern. And to me, that's nice explanation in hindsight, but I want to know what it's going to do before it forms it. Okay, so that's what I teach my students. That's what I'm trying to teach you, but in a higher form of education, not just simply basic retail patterns. Now, I'm not suggesting that anyone that studies those or use those can't make money. Obviously, you can make money flipping a quarter. If your risk management is on point, anything that's a catalyst that causes you to make a decision. Last time your elbow hurt, it rained. Now your knee hurts. That means, S&P is going to go up or down. Whatever the thing is that you have faith in. Okay, if you have sound money management, you probably can make money with it. Maybe not a lot of money, but you could probably eke out some profit, right? Well, in terms of looking at price action, I want you to look at how the market gravitates towards liquidity and inefficiencies. That's the only two things that the market will do. If it doesn't do either one of those things, it will go sideways and consolidate until it meets a criteria that allows for it to do those previous two things, which is go up for buy stops or go up to an inefficiency. An inefficiency would be something like this, where between these two candles, this candle here and this candle here, there's one candle there. The difference between this candle's high and the difference between this candle's low is the pass-through of this one candle. What direction did it go? Up. So what does it mean? What does it need to do to make this inefficiency efficient? It needs to offer price going down. Okay? So if we add some detail to this chart, we have this imbalance here, and the market goes just short, or just above in this case, above this candle's high. This candle's high comes in at 4061 and a quarter, and the low of today, my day, Thursday, because it's in some of your local area, by the time you're watching this, it may be technically Friday where you are, the 5th of May. But right now where I am, in my time zone, it's Thursday still at 9:16 p.m. But the low of this candle comes in at 4062 and a quarter. So it's just one, was it one handle? High come, yeah, it's one handle shy of meeting that candle's high. Okay, so that was one of the factors I had when I mentioned that we're 50-50 at this point around the noon lunch hour. And we'll talk about when we get in lower time frames. But that was the catalyst to cause me to tweet to everyone saying that, okay, now because we've taken this particular target, and you can find that tweet on my Twitter feed, it's 50-50, so I'm going to take 3 contracts off of the 6 remaining I had. And I recorded all that stuff and showed it on Twitter. You can watch it. But ended up becoming the low of the day. and then it rallied up and made a move back up into a short-term premium intraday. So I'm saying all that stuff, and if you're new, if you're not really versed in what I'm teaching, what I've taught on this channel, it sounds like a lot of mumbo jumbo and it went right over your head. But I promise now when we go in the lower time frames, because this level's highlighted, this blue or teal colored range, I want you to be aware that that right there is anchored to this area here on the very specific candle of March 30th. Okay, so if you go on your daily chart for June contract, the symbol for this, if you want to pull it up on TradingView, is ESM2023. Okay, and I'll type it out for you real quick, just for completeness sake. On TradingView, you would type in this symbol here. Okay, you would type that in right up here. When this contract expires, I just want to toss this in here real quick. When this contract expires, the third week or so of June, this symbol will turn to that. And the U stands for the contract month for September. And when September expires, the U will become the letter Z, like in zipper. That's the contract month for December. So the contract months expire, but right now we are in June contract. And that symbol M is the delivery month code for June. There's one more month in the whole calendar rotation. It's H, and that's for the month of March. So there's only 4 delivery contracts for index futures: March, June, September, and December. Symbols being respectively H, M, U, Z. Real simple, real easy. Now with that out of the way, in this area here shaded, if we were up here at a premium above this old high, and discount or sell side would reside below here, what PD array beside the sell side would we couple it with? The buy side imbalance, sell side inefficiency, or this fair value gap. Okay, so now let's go down into a 60-minute chart. All right, on the hourly chart here, you can see how on Tuesday and Wednesday, the market repriced up to this city, traded up into it here, in between the imbalance that's formed here. The market traded up and aggressively broke lower here. And then we had this new day start up here overnight. Now when it says Wednesday, that's my local time. But all of this is part of Thursday's trading. Right here is midnight to 1 a.m. So this is all part of, technically, the trading day that's seen on TradingView. So this separation between where we closed right before the 5 p.m. shut off for 1 hour and then it resumes at 6 p.m. The difference between the opening price at 6 p.m. and the closing price at 5 o'clock Eastern time in the U.S., or basically New York local time. So in TradingView, I say this all the time, but I want to make sure I'm being complete all the time because I don't know if this is the first video you've ever watched. And it frustrates many of you because you want to get to the point, but the point is I'm educating. And you're not the only student I have, so I want to make sure I'm providing the details to help people that may be following me just for the first time to have all their coordinates, in the right place. So that way you can follow along as well. And it saves on me answering a lot of questions that keep popping up. At least that's my attempt to try to stave off most of that. But I'm not 100% successful in that, obviously. But anyway, this area here, we're going to talk about that. That's the ICT new day opening gap. These bold lines in here, that is my new week opening gap. So this is where the separation between Friday's close and Sunday's opening price, we extend that in the future. Now right away, when I talk about that, everybody says, well, you didn't invent a gap, ICT. No, I didn't say I invented the gap. I am pioneering the idea of using these gaps through an extended period of time, casting forward into future price action. Because just because we fill the gap doesn't mean we're done with it. That's what separates me from everybody else. If that gap forms, it's meaningful, it's salient. That means the algorithm will refer back to that same area again, and it will do so for weeks and months at a time. Now, while you're learning, and you're learning how to do this for the first time, I've counseled everyone through Twitter and Twitter Spaces, where I first introduced it in February of this year. So 2023, New Week Opening Gap was coined publicly, but it's been mine since the 90s. But you want to know that that origin was taught originally from me in February in Twitter Spaces. So there really isn't a video per se. Now, a lot of my students have come up with things real quick to throw on YouTube and try to share their understanding or interpretation. And they're just introductory. They're just like introductory to the idea. There's a lot of things that I can do with these things, and you'll learn to do as well. But for now, the basics is simply this. Try to have at least 5 of the most recent New Week Opening gaps. It's important for you to have in your journal, every time you have a new Sunday opening of a new trading week, on your Sunday journal entry, always record what the opening price is and what the previous Friday closing price is. That way you'll always have that information. You can have it ready at your fingertips every single time you need it in the future. That way, if something happens in your chart, say I've done this before, say you deleted things on your template. Okay, so you can see up here I have New Week Opening Gap actual. Okay, don't worry about the actual. I will teach those things in the future, but sometimes I'll delete a template thinking I have something transferred or transposed on another template, and I delete them, and I have to go back through my notes and pull up all that information. You don't want to be searching through candles like this looking, okay, is this a Sunday? Is this a Friday? You don't want to do that. So it's real simple to write down in your journal every Sunday the markets that you're trading, what was their previous Friday's close, and yes, this works on Forex. Yes, it works on just about every asset. I can't vouch for crypto. I don't trade crypto. So my students do, they swear by it, but I don't have any opinion or input in that regard. But every other asset, it works, okay? Synthetic indices, please don't ask me about them. I don't know anything about it. I've never touched them, and I don't even know what it is. So there you go. But the running tally of what your previous Friday's closing price is and your Sunday's opening price. That means the very first tick on Sunday at 6 p.m. When the markets come alive again, boom. When that happens, it's real simple. Check your charts on a 1-minute chart. What was the opening price? Write it down, journal it. It's done. You have it. Now, in the olden days, when I first started in the 1990s, I had a 3-ring binder, and I would just have a graph paper, and I just wrote down every single Sunday opening price and Friday's closing price. And I would have the opening range of the first 30 minutes and the first 60 minutes at midnight for all the markets that I traded. Okay, and I will teach you that as well. I've already taught it, really. If you go through the core content, it's taught when you're looking at day trading stuff. But that idea can be applied at multiple time frames throughout the sessions, like the Asian session. It can be utilized in the New York session, the London session, and the PM session in stock indices. So there's lots of concepts I'm going to teach you throughout this year, but it's not important for you to try to bring all of it into your trading plan. That's the mistake, and I mentioned this on Twitter, and I know some of you are getting really frustrated now because you want me to get into the heart of this teaching. This is the heart of the teaching. I'm trying to teach you what not to do, because just because I'm teaching something or taught something somewhere else, don't think that you have to reach for everything I've ever talked about and try to apply it to right now's price action. That's not what a model is. That's you trying to have a kitchen sink approach where you're trying to apply everything to whatever it is you're studying. And that's too much. Okay, it'll create analysis paralysis where you really won't know what to do with the information. It's too much. And many times they may become a conflicting idea where you don't know really what to do, and it becomes frustrating. So you kind of want to limit your focus to a specific thing or two within a bias. That's all you're going to do, okay? And I'm going to kind of teach you today, in addition to what I've already taught before, how you can take a simple approach and apply it with a template in mind for a trading day. And I'll cover what I mean by that as I go, but just know that what I'm teaching here today is not a be-all end-all. Just like anything I've ever taught, just like anything else out there in trading. By itself, it's useless. It's just one component to a model or a trading approach, unless you have other factors that help you decide whether or not there's a good time to be trading, because there's lots of times in the calendar year that you shouldn't be trading. There are certain days of the week and specific weeks of months that you shouldn't be trading. In my opinion, new traders or new students should not be trading on Thursday and Friday of non-farm payroll week. I don't believe that's what you should be doing, because it's very difficult for a new trader to navigate that. They don't have the skill set. And that's not me trying to be condescending or talking down to anyone. That's just my experience. And it takes a lot of understanding about what price is likely to do ahead of these employment numbers that are released at 8:30 on Friday, typically the first Friday of every month. Not all of them, but generally it's the first Friday of every month. That day, you should just mark it off as, you're not going to trade. Now, does that mean you shouldn't trade at all that day? It just means that it's likely to be a very difficult trading day, and it's a gamble. After the non-farm payroll numbers come out, if you want to take some action there, then you decide whether or not you want to do that. But you should not be trying to trade a non-farm payroll event, because you can do all kinds of wild things and hurt you. All right, so I have here March 5th, new week opening gap. Okay, so that'll help the individuals that have already seen the video where I was trading with this information today, and it's been shared on my Twitter feed. So we have that blue shaded area, which is that fair value gap below an old daily low. The market digs into that today here. See that? We're going to go into smaller time frames now. We're going to drop right into a 15-minute chart and start adding more detail here. And I have this candle here. I mentioned this on Twitter today. That's a bearish order block. And I very specifically here now, the 4-hour chart here, I want you to go back to this. See, this is that swing low and sell sides below that, and we got real close to the bottom of that old imbalance, that buy side imbalance, sell side inefficiency, or fair value gap. I'm going to scrunch it up real quick so you can see where it's at. And you can't see the fair value gap here, but on the daily chart, that's where it was. On the 4-hour, you're going to see this imbalance. This is the reason why I went to the 4-hour. Because once I get into lower time frames, you won't know where these other lines are anchored to. So this high on March 29th, that candle's high on the 4-hour, and this candle's low here on the 29th at 6 p.m. Those are the two separating candles that make up the range between this candle here. So in other words, you see how this candle had a up, down, and then this candle up, down, candle up, down, and up, down. There's no imbalance here. There's no fair value gap until we get to this candle here. So I'm not trying to reteach fair value gap. Hopefully you can see, and this is how you should have your charts, by the way. I see a lot of people doing this. They zoom in and they're watching price like this, whether it be a 1-minute chart, 3-minute chart, 5-minute chart, 15-minute chart. They have it all spread out like this. Okay, you want to have some, you want to have some chart real estate on your screens. You don't want, or screen rather. You see how it's easy to see that fair value gap? You want to scrunch these up until it's real easy to see the separation. Oh, there's a gap right there. So that's what I'm highlighting. And if it were to get below that daily imbalance, remember we shaded that blue area, okay? If you don't know what I'm talking about, watch the first couple minutes of the video when I start showing the lipstick on the chart. This would be the next discount array if we were to trade down through it. That was the draw, 40, 52, 50. Okay, so the basis was it could reach down here, but I'm being cognizant of this range here that was the daily chart fair value gap. And you'll see me use that mindset with what I'm going to show you now in the lower time frames. So here's the 5-minute chart now. Okay, so here is that order block at 4099.50, and it's anchored on Thursday, May 4th at 6 o'clock. in the morning, 6:15. We have a fair value gap here and a order block, which is the last two up close candles here. It hits that, trades down, comes right back up, rebalances at a volume imbalance, which is the difference between this candle's body and this candle's body. There's a separation there. It's not a technical gap in a definition by anybody else, but that separation is what I refer to as a volume imbalance. I saw an individual make a remark to me on Twitter a few days ago saying that he didn't agree with what I was talking about and said this is not order flow, and I know that. What you call order flow and whatever you refer to as order flow, maybe you think of it as contract volume, market profile. Maybe you're using the VWAP and point of control and all those things. To me, if those things help you, that's wonderful. But you're looking at things from a retail mindset. I'm not looking at things from a retail mindset. I'm looking at things algorithmically. These things are going to reprice to these areas because they're coded to do that. The market's going to go right into this little area, this little separation right there. And let me magnify that, okay? And I want you to see. So there's the volume imbalance. See that candle's body at close and then next candle open right here. There's no wick. The open is the high. So that separation right there, that is a volume imbalance. That means that the algorithm has not offered price to the marketplace efficiently between these two price points. So it's kind of like a micro fair value gap. That little area right there, okay, and there you go, micro fair value gap. There's going to be all kinds of people writing books on Amazon trying to get my information in print before my books come out, where my books will be completely intact with the logic. Everybody else will be talking about something that's going to be useless to them. But here you go. We have this thing here. Let me do the business where you do extend to the right. That way it'll be easier. So now when we drop back out, you can see how in that volume imbalance, the market reprices right there, boom. Now, how that works, everybody that is impulsive, everyone that is new to trading, they don't generally use stop orders, either for protection or for entry, and they very rarely use limit orders too. So what's the type of order they usually gravitate to most when they're trading? Buy it at the market, sell it at the market. And admittedly, I like to do this live. Sometimes I'll just go right in there and press the short at the market or buy at the market. And I'm doing that to kind of get as close as I can to what you as a neophyte, someone new that's never done the things I'm teaching, never implemented it before, or maybe never even had an engagement with price action. I use the market entry to get myself as close as I can to what you as a developing student would do if you were just starting out. So that way it gives me the opportunity to have what you might encounter where it's not as precise. Whereas if I used a limit order, and how would I use a limit order? Say if I wanted to sell short, okay? And I'm taking a great deal of liberty here because if it's the first time you've ever watched me, it's going to seem perfect because it's hindsight, right? I'm pointing out the things that were obvious. Grant me the latitude to be able to do that here, okay? Because I promise you're going to see executions in the latter portions of this video. I promise you I pushed the button today. I promise you that it's really recorded, okay? I'll even show you the whole history, okay? But the point is this. I want you to understand that if you grow in your understanding of what it is I'm teaching, and we're going to teach order entry and all that type of stuff too, and the difference between market orders and limit orders and stop orders. I'll give you executions of that as well this year. Okay, so I'll give you the logic, what we do, how we're using it to get into the market or get out of the market, or include more entries for pyramiding, like you watched me do on Twitter today, and you'll see executions of that. But if you wanted to use this entry here, to get in sync with the bearish order flow. The algorithm will price right back up between these two candles because it's inefficiently delivered. There's a gap there. So the algorithm is designed to offer to the marketplace efficiency in terms of both a constant continuum of buy side and sell side. In layman's terms, every price is offered at least 2 times. That means on the pass down, going down, and as the market goes lower, okay, once it passes through a particular price range or a particular price level, once it passes down going down, like it does here, it doesn't offer a body. So what the algorithm does, it sees that separation between these 2 time intervals. And the algorithm is constantly cycling from a higher time frame down to the lower time frame. And it's doing it in such a fine level of detail. It's looking for these little pockets, okay? And it's doing it so fast in terms of calculations, it's constantly going through a script. It's seeking these things. And what happens is the market, because there's participants always coming out wanting to do what? Market orders. So when the market's trading up here, at one time, this candle was just about to be in that little shaded area, but it hadn't been there yet. So this was all a bold, bullish candle, green in my case here, but it hadn't got into that little shaded orange area yet. And then someone comes out and says, I want to buy or I want to sell at the market. And the algorithm simply jams the price that's being available to the marketplace to that order that it knows that there's a constant flow of what? Market orders, market orders, market orders. Oh, there's not that many market orders. Sure it is. As soon as an area of buy stops get hit, those buy stops become market orders to buy at the market. Whenever there's a pool of liquidity that has buy limit orders, those limit orders get triggered and they become what? Buy at the market. Just limiting how much they will be willing to pay on the limit basis, but they immediately become at the market. See, it's what you have learned and how you've learned it that has skewed your perspective. And you think because you're using these retail ideas about order flow and you're looking at level 2 and you're looking at the depth of market and ladders and all that stuff. Look, I'm familiar with all that stuff. I've been around for a long time. I understand all that. Okay. I'm not trying to disparage against it. I've done it in the past, but I don't believe that's an advantage. It's not advantageous to anyone. If you believe it is, there's nothing wrong with that. But trying to go around with a sharp stick and say, you don't know what you're talking about, that's not order flow, you don't know what real order flow is. Because the depth of market and level 2 data, that can be spoofed. These things aren't going to be spoofed. The algorithm is absolutely going to go there and offer efficiency. So that's why you're seeing that. And that little movement just above it, that's because that price, on that closing price, to get that price perfectly, it has to go 1 tick above. So what's the closing price on that candle I have highlighted right here? What's the closing price? That's this one right here, okay? It's 41.01 and a quarter. So that means it needs to go to what price? 41.01.50. What's the high of that candle right there? 41.01.50. Hello. Sounds like Daddy wrote something. Yeah. So anyway, you have this order block. Okay, it also trades up into that, but it goes through the order block. How far can it go through the order block, ICT? Well, it's going to go right into that inefficiency right there. Now, that time of day, right here, the market trades up into 8:30 a.m. The news that comes out at that time today was what? Employment data. It was completely random, right? The market rallies up there and goes into that little section of price action and then consolidates right in here. And then starts to do what? Take a dive. Now, I want you to think about the logic. If the market was willing to go up in this order block and it traded up into an area that I teach, this is a volume imbalance, okay? It's not in books. It's mine. I authored it, okay? I codified it. It's here. You're talking to the author. Or listening to the author, let's say it that way. I want you to think about how you could use that information right there. Also, I want you to think about how that shaded area here, that pink area, that's premium. This green area here is discount. If we were to go over and scrub back over to the left side, I promise we'll come back to that area. This is where Wednesday's closing price, right before 5 p.m., the last traded price here on the 5-minute chart, we're noting that level right there. And then it opened at 6 o'clock right down here. So the difference between that is what I call the new day opening gap. Now, when this forms, people that look for gaps, because I didn't invent a gap, the theory around my gap theory, okay, the idea of implementing the information that you can be using in your trading is not limited to, okay, we have a gap here, and as soon as the price goes right to there, that's it. Everybody else is done with it. The gap's filled. We're done. That's not me. I'm not retail. We don't have retail logic here. We understand how retail traders are going to view the marketplace. I teach you how large institutions and fund managers view the marketplace. So that way you can see how the algorithm cannibalizes them. So that way you're not surprised. You're not taken by surprise where the market does something like, what caused that? Wow, where did that come from? You're never going to hear me say that. That's why I'm very facetious all the time in my Twitter feed. And I'm being sarcastic a lot. Sometimes it doesn't come across because of a language barrier between you and I. You may be from another country and you may not be able to pick up on the level of sarcasm I have. But many of my tweets are trying to be dry humor. And I may not, it's kind of like dad jokes a lot for traders. But the idea is these things form and repeat. Now, there's also this March 5th, you see, I'm trying to move it so you can see it. March 5th, new week opening gap, and March 5th, new week opening gap low. So the high for that particular week is here, and the low of that, where it starts on Sunday of that week, on that 5th of March, and the previous Friday. So I think it would be like what, March 3rd? March 3rd and March 5th. So the Friday and Sunday respectively. The date is March 5th for the Sunday. Okay, so that level's highlighted here. That's why I have this template called New Week Opening Gap. So what I'm showing you is how to have these levels on your chart, but I want you to look real close. Without me saying anything, what do you see? You notice anything? The new day opening gap here gets filled right there by everybody else's expectations. But is it really? No, it's not. This is simply just repricing back to that level there. So between this closing price here and this candle's opening price, there has been really no trading except for these little wicks. This here and this here. Now below the candle, it's usually called a tail. And above the candle, it's usually called a wick. Sometimes I'll interchangeably use both, calling it both a wick. But technically, that's what you're going to see it as, a candle's tail and a candle's wick. There's a separation right there that has no trading at all. Wicks, I treat those as gaps as well. So in my mind, because the algorithm sees these wicks here the same way we as humans see that gap between this candle's low and that candle's high. So what does it need to do? It needs to pass through 2 times. What does that mean? Where this candle opens, watch what happens. The market trades up through that price point here. In other words, think of that shaded area. We trade from the low of it all the way up to the high of it. Then it consolidates and does what? It treats it as support. Rallies away. Wonderful. Are we done with that gap? I'm not. You might be. The guy that wrote a book that talks about gaps, or the people you watch on YouTube, or someone else in a Discord, or somebody else on a Telegram channel, or somebody else is taking my stuff and think they understand it. They think, okay, the gap's done. We're done with it now. Let's look for something else. I'm not thinking that. What is it lacking? Sell side delivery. What does that mean? Well, we've had buy side here, which is price movement up. This is order flow. It's 1/2 of the price delivery continuum that these algorithm theories are based on. You can't just simply call this a gap closure and we're done with it. That's myopic. The algorithm has to do what with this still? offer, sell side. So buy side was offered. That means from low to high, price went up. Now we have to see a pass through on the downside. This is real order flow. The market trades from the high end of it down to the low end of it. Wow. Interesting. It also finds support at that old March 5th new week opening gap low. Well, isn't that interesting? What does the market do then? It rallies back up into that volume imbalance. The market is bearish. Why do we know that, and how do we know that? Well, ICT said to focus on 4068.75, and individuals on Twitter were saying, no way is it going to go there. Okay. It went there. But the point is this. When I'm talking to you on Twitter, or if I go through the motions of outlining something that I'm interested in, which is what I've been doing, I'm counseling you to submit to my experience so that way you can watch price the right way. That way, I'm lending you my 30 years of experience in being able to see this stuff before it happens. The concepts are mine. I codified them. I authored them. You can't use them correctly without me guiding you. So I'm pointing to specific things in Twitter or when I do live streams. And when the market gets a little bit cleaner, I'll be back to live streaming. But right now, Twitter's enough. The market trades up in that volume imbalance, consolidates, hits the order block, remember the 15-minute time frame, and then drops, rallies one more time and fails. Then strong rejection lower. So what was going on here at 8:30, right there, when it rallied from here up to here? That was that employment number that came out. Employment claims at 8:30. Look at your economic calendar. Okay. It trades up into some random high, not so random when you're spending time with good old ICT. That volume imbalance right there. So I was watching that and I wanted to see, does price hold at that level and then reject and then have difficulty at the order block that was at 15 minutes. I talked about this on Twitter this morning. Inside this area, near the high of the old gap that everybody else would have forgotten about, which was the opening at 6 p.m., most people really don't trade that gap. They like the gap that's formed in the morning, which is what they call the overnight gap. It's not really an overnight gap. It's the opening range gap. And I have lectures coming that will teach a lot about that. But for now, I want you to see how I navigated this week, how I looked at this particular day, made over 100 and some handles total for the week. And you can see right now, if I right click on this, go to settings, right away, I have to say this because invariably I get this as well. If I'm supposed to be this rock star in trading, and I made all these concepts, and I've done this, and I've saved the world, ended world hunger, and all these things that people like to embellish and add to what I've only claimed that these are my concepts, and I authored them, and no one's going to be able to teach them better than me, and you're not going to find anybody that can do it as good as me because they're mine. That's not bragging. I do that because I get so many questions by email and so many questions through TradingView or questions by Twitter. They'll ask me, what do you think about this guy that's teaching your content? Or what do you think about this guy that's doing this with your content? Listen, I understand there's a lot of people that are interested in it now. My opinion is if you want to learn it, you come here. I'm doing it for free, and you're going to get it right from the source. There are a lot of people that I've trained, lots of them, and they use my name to draw a crowd. I've given them the permission to do that. But you, as the student, have to exercise due diligence and demand that they can do what they claim they can do. Because if they're going to just talk about something that's already happened in hindsight, which many of you probably feel that's what's going on right here, and I promise I'm going to dispel all that right now. You have to understand that there's a lot of people that can take this language that I've given out to the public, and they can sound smart in hindsight. They can explain it away after it's happened. But it's altogether something different. Sitting in front of a live audience, 250,000 strong, 500,000 strong, and call it with no safety net. I don't need to have a live account to show you this stuff works, because if it doesn't work, with a demo, which is what every funded challenge starts with. You're all trading with a demo account. It's not real. And if you start with $150,000, you're trying to make $150,000 turn into a 6% gain. I think it's like $9,000. My son failed several of them trying to do something he was not equipped to do, which everybody knew that. I mean, they asked, what is going on with your son? I'll tell you, he failed 7 times. 7 times he failed because he doesn't know how to trade yet. He thought he could do something on his own. I'd let him do it. And 7 times he failed. And Top Step would confirm that. And there's no shame in that. He thought he could do something. He was going to try to do it his own way. And now he's got to go back to square one. And that's wonderful. Now he's teachable because he wasn't teachable while we were trying. So now humbleness is now part of the equation, which is necessary. So when I show this, I want you to think about the logic with some people that may come to me and snicker and say in other areas around the internet and say ICT only does this in demo. Okay, if you're going to try to get a funded account passed and get into a funded account, you're going to be trading with a demo too. And a lot of the funding companies are literally coming at me saying, do a funded account with us, do a funded account with us, I'm not going to do it, folks. Okay. Without saying anything more, which would be viewed as being disrespectful, just be thankful that my students are choosing your company. Whatever the company is, I don't want to rep anybody because if I do that, it sounds like I'm in bed with a company. And I don't want to do any affiliates. I get lots of offers. I don't want to do it. But when I show you this, I want you to know that it's important. See these little arrows here? And I'm showing also, it's not market replay. Market replay has nothing to do with this. When I click on this, it tells you the prices. You see how that appears? That all this stuff were real executions. And when you see it like this, you can see that there's a logic being implemented. Everything I've outlined here was the logic behind how I traded it. I was bearish today. I explained that to every Twitter feed follower that has. And yesterday I was bearish. And it behaved wonderfully yesterday as well. Go watch and look at my tweets. I got so many requests coming at me. Do a funded account, do a funded account. You can't pass a funded account. You can't do this, you can't do that. Okay. And I used the specifications that like Top Step, or that's the only company. I apologize for other companies out there because it sounds like I'm not advertising for you. I'm not advertising for Top Step. Okay. But I know because my son tried this, they offer $150,000 funding and you got to try to make $9,000. Okay. I want you to look at the executions here and what I'm showing the logic. I'm selling short up here, building in a position. They say you can trade with 15 contracts. I built up positions up to 10 contracts here and never would have been stopped out. Never would have breached their 3,000 max loss day. Never would have happened. You can do the math here. You can literally watch me do the executions recorded and shared on Twitter. I called all these levels the particular day here. I called all that stuff on Twitter. Now, there was a small period of time where my phone went into automatic update because I kept hitting remind me later. Every time Android, I have a Galaxy Note 10. And Apple sucked, by the way. I'll never have another Apple device. But the bottom line is this. I was talking nonstop about the market today in tweets, pointing to where I think it's going to go and how you should follow along. And we were looking for very specific price levels. In this shaded area here, you can see how the market dropped down. We were looking for 4070 something or other, 4075, 4076 in that area, which was the top of that shaded area. That's the reason why I liked it. It's also an old low. You can see how I covered 3 and then it got stopped out on the balance of 7. But it was cut off and stopped out in profit on the balance. At the time of the recording, you can watch that on Twitter. I'm not going to splice that in here. I went back in with the expectation. As soon as we went back up to new week opening gap, which is from March 5th, that's these dark black lines here. Okay. Once it traded back up into there, I sold short again and built in another 10 position contract short, pyramided it in, scaling in. When I do this, my typical MO is if I want to take a trade that I think is favorable, I have the probabilities behind me, I'll go in with 6 contracts first, then 3 contracts, and then 1, and it gives me a 10 lot. That's how I usually build it in. That's my model. Doesn't mean that you should do it that way. Doesn't mean you should be trading with 10 contracts either. I have the experience to do so. Okay. The market trades into this level, allows me to build up the position, and then it trades down to the lower end, and then the targets, once we went below this low here, I took a partial there. See that right there? Watch the arrow up here. Right there, and then down here once it gets below that low. So I'm scaling off profits there, and then got stopped out on the bounce again here. Then on Twitter I said we were looking for 40.63 was the next sell side, which was below this low here. I'm going to take these executions off just for a moment so it's a little bit cleaner. I'll put them right back on in a minute, I promise. So look, you can see what's going on. I went short here, which was the high end of that discount array, or the imbalance on the daily chart, expecting it to revisit and go after the sell side below here. So what's the low of that candle right there? 4063.50 up here's where you're going to be looking for that price level, okay? That candle's low, 4063.5. So I want to get something lower than 4063.5. And I'm shorting up here. Why am I shorting right there? I'll show you. It's a breaker, okay? You can see it here. High, low, higher high, and then sells off here. I made a remark on Twitter today, which I'll build on when I go in the lower time frames to show you the actual breaker that I was looking at. But this is it on the 5-minute chart. So I'm selling short inside that breaker. Right in here. I'm going short there. 6 contracts. Adding 3. What price do I got to get? Below this price low? Low of 63.50. So 4063.50. I have to aim for something lower than that. My limit order fills at 4062.5. I take off 3 here because I believe that we're probably at a low of the day because we're going into non-farm payroll Friday price action. It's delivered 2 of my targets. And where are we at in that fair value gap on the daily chart? That shaded area in blue? We're near the low of it. And what time of the day is it? Noon, New York local time. So we're in lunch. So what can it do? Run the stops. What stops? The buy stops above here. And what does it do? Rallies on it. So I took 3 off here after the first 3 here at 4062.5. I closed manually 3 at 4065 3/4. Then got stopped out. And you can see that on the video. It got stopped out on the final 3 in profit of 4072.25. And then waited until what time of day? 2 o'clock. Went in short again. What am I shorting? I'm shorting on the idea that we went all the way back up to the high of what area again? That new day opening gap. The separation between what? Where we started trading at 6 p.m. my local time on Wednesday, and then we stopped trading at 5 o'clock on my local time on Wednesday. So that's the new day opening gap. Extend that forward, folks. The algorithm is going to refer back to that same price level again. Anybody that tells you once a gap fills, you're done with it, discard and dismiss what they just said. They have no idea what they're talking about. I promise you. I'm not trying to be disrespectful. I'm not trying to be belligerent. I'm not trying to say don't look and learn from anybody else. I'm just saying if anything I'm saying and proving that it works, and they have books, they have courses, they have mentorships, they have things that they're trying to teach you, and they say this is the way to do it, they're not fully informed. That's all I'm saying. Okay, that's all I'm saying. You decide who you want to listen to. But, you know, the devil's in the details here, folks. So I sold short here because we went up to the bottom end of that same new day opening gap. In the next candle here, we open, and by the time I got to the screens, it allowed me to get filled there at that price, 4085.25. Stop was above the new day. I'm sorry, the new week opening gap on the 5th of March. One more time, bumps the low of the new week opening gap of March 2023. Then accelerates to the downside. And what am I aiming for? The sell side right below this low here. What's this candle's low? We're looking right here, okay? Up here in the upper left-hand corner. The low of that candle is 4071.75. So what do I have to get? I have to get a fill of 4071.50 or less. So I had a limit order placed right below there, and 9 order was filled at 4071.50, one tick below that low. And the low of the day was 0.25. Or not low of the day, but low of that candle. So I was within the measurement of one tick. Then it rallies back up to what level? Some random level, right? No, it's the new week opening gap from March 5th. And it's also what, folks? The new day opening gap, that shaded area. The algorithm is going back to these same price levels. Okay? I was all over this thing, but I had to go shopping with my wife, and I was going to take another short from here to take out that low, and I would have done the same thing I did there and added more to it. And then what does it do? Once it takes the sell side here, where's it going to go back to? Buy side. Where's buy side? Above that short-term high. Also, where else? Consequent encroachment, which is the midpoint between a high and a low, a new week opening gap. Midpoint. Bang. Where's it go? Down. Where's it going to sweep again? Old order flow. That's the real level here. Not each one of these, because now we have 1, 2, 3. Where are the bodies? They're stopping short of that low. So the parent price swing and liquidity pool is this one. I'll have more about that in my book. But the point is, you like that plug, you like that little twist of the knife. Oh, ICT, you're so diabolical. Whatever. But the point is this. The market trades back down and rallies back up, falls short of this high. But now what do we have? What do we have here? Relative equal highs. Runs right through them and goes to what level? The high of the March 5th, 2023 new week opening gap high. Look at the candle work right there, folks. Look at that. That's not random. It's gravitating to these same levels because you think it's buying and selling pressure. And you think that the depth of market and the DOM, the market profile, the VWAP, and all those things, you think that's order flow. You think that's really measuring the intricacies of price action. And you have no idea what you're doing. No idea. So to answer the folks that ask me to go do a funded account, do a live account, do this, do that. Listen, I've done all that stuff. Okay, I've done a live account. I put it up there. I even flipped a quarter and still made 100% in 5 weeks on TD Ameritrade. You can see it up there on my YouTube channel. There it is. In my opinion, I did what I think a new student would do in the course of 1 year, but I did it in 5 weeks. Okay, I think making 100%, which is exactly what I teach, to try to aim for 6% a month. Will you hit 6% a month? Probably not. But if you did, you could double your account. Regardless of whatever the account balance is when you first start it, you can double it. So my question to you is, why are you asking me to perform tricks when I do this all the time? I'm calling it live. I call it live in tweets. I can't erase them. I can't delete them. I don't delete anything. And when I'm doing live streams, I'm literally calling every 1 minute tick live on the lowest latency. You get the highest degree of delivery from whenever I say something, whatever my chart's showing, you get it on that stream right to your computer as fast as the internet will give it to you. And I'm doing it without a safety net. So you see people out there saying all kinds of terrible things, ICT this and ICT that. This is every detail, okay? Every single detail shown. I'm not hiding anything. There's zip shown elsewhere. It's all shown here. There's nothing else I can add that can be toggled. I'm going to physically walk through every single one of these. This is the first trade. You see all the details that pop up here? Okay. This account started with what you would have with a funded account challenge of $150,000. You got to make $9,000 in 5 days. Folks, I did $19,937.50 perfectly today. Perfectly. Multiple times. And I traded in a day. I teach my students don't touch. I was all over this thing like white on rice. The next trade, here's the details. Here's the details on the next one. These are all partials or entries. Okay, look at that. Okay, see that? You can pause the video and look at everything. I'm not hiding anything. I'm not doing things surreptitiously. I'm not gaming TradingView. I have an account that I force my son to do executions on. He practices. He does things. He shows things. TradingView, I'm sure they can watch my account. Bottom line is, they can see when my son's pushing the button versus when I'm doing it. When I'm doing it, I'm murdering it. I'm literally all over this thing, murdering it. When things aren't looking kosher, when they don't look like they're really making sense, that's my son being told, execute when you think there's something to go on. And he gets frustrated and he reboots it, starts it over. I'm going to do that right now because I don't like keeping a running account. Because I know if I was at TradingView and I could see ICT's trades, I would put a trade copier on this. I'm not allowing them. I won't allow them to do that. I'm not suggesting that they are, but listen, you would do it too. I know I would. If I knew the hottest dog in this industry that can do the things I'm doing, improving and teaching people making $500,000 in the same year or so, or a little bit more than a year, folks, that's somebody to watch. That's somebody to listen to. And if they can find a way to mimic whatever they're doing, if I push a button in a demo account and I run these accounts up like this, wouldn't you want to put a trade copier on it? Do you see any losing trades here? No. I facetiously in the past do things just to make red appear in here. I can do this every friggin' day. Every day I can walk these markets up, down, sideways, whatever you want to do with it, I can do it. I don't need to do your challenges. I don't need to do your championships. I don't need to do your competitions. I don't need to do anything because what I'm doing is far, way, way, way better. Light years ahead of everything else. Period. So do the math on this. Let's just pretend that I took these types of trades over 5 days. I would have smoked any of your challenges and I would be funded. I don't need to be funded. I'm already friggin' rich. I don't need to do it. I'm teaching you. You're the student. If you don't want to learn from me, go somewhere else. I'm not holding any of you hostage, but I'm not going to be doing tricks for requests. I'm not doing party favors. Hey, can you do this? Can you do that? I'm not doing that, folks. I'm teaching you how to do this. I'm literally spending my time, which I don't have to do. I'm spending my time with you, teaching you exactly what you should be doing the correct way to learn how to do this independent from me. Because in November of this year, in 2023, I stop. I want to have my life back. So take the time, instead of asking me to do tricks for you, instead of me trying to perform something that's easy for me, just because you can't do it or you think I can't do it, I can do it anytime I want. Anytime I want. I can trade in any market condition. If it was a real tight, sloppy market, like when I went down to Florida and South Carolina in my RV, I could have done a whole lot of 3 pip handles, 2 pips handle, and ran up something just like this. It would be like 50 trades, but I can get these same results here in small little market increments. Like you have no idea. You have no idea. I'm giving you models that you can do very, very well with. You don't need to do this many trades, but I just wanted to convince all of you that are on the fence thinking that, oh, well, he does this because you listen to people. They lie because they're selling something or they're just short of an attention. They don't get attention where they're at in the internet. So because I get a lot of it and I've worked my ass off for it. Nobody else is doing as much as I've done in this industry for free. And I've given my core content that people paid for free on the YouTube channel. Hello. Ask everybody that's selling stuff to give their stuff for free. Think, folks. I have the goods. I'm making real winning traders. I'm producing winning traders. They're being interviewed. They're getting paid out. They're getting real money. They're starting with things that they didn't have the money with. And I said this in my mentorship. You can find people that will partner up with you. Now there's funded accounts. They didn't have funded accounts when I first started. They may not be in existence in the future. They may be regulated to the point where they're not permitted. I don't know. I can't see in the future in that regard. But even if you don't have a funded account, a company working with you, if you can produce results, believe me, there's always somebody out there that has money. And they will say, hey, let's go into a partnership, a limited partnership, you and I, we go into it, both of our names are on the account. You do the trades, and we'll split it 50-50. There's nothing illegal about that. There's zero illegal things about that. You're going into a partnership, and it should be legally binding. You don't need money to do it. You need the skill set. Once you learn the skill set, it's yours. Nobody can take it from you. Nobody can talk it down. Nobody can discount it. Nobody can say it's not real, or it's fake, or it's this and that. Folks, these are results that people want to have. This is the stuff that people want. Everything here is shown. Every box is toggled. Everything here is shared. Nothing is hidden. Nothing is photoshopped. I can't get this thing to scroll down. There you go. There it is. Okay. Everything is shown. Your challenges are Mickey Mouse to me. This is nonsense. Asking me to do something that is nothing for me. Like $9,000. I don't need multiple accounts to do that. I don't need to have, all these things linked together and have trade copier on 3, 4, 5 accounts that, to see things pan out in my favor. I can have one account and not even use the maximum 15 contracts. I can do what I teach and what I show always. I didn't create something new today to do this. Everything's here, folks. And this is what I do all the time, because I don't want people in these companies that I execute on and teach my sons with to copy me. So now we're back at 150. I didn't erase a bad account. I didn't reset a bad account. I'm doing everything here that I do all the time. I round up accounts to show my son, and I'm showing you, and I reset it. Now I tell him, now you do this, you do that, you do this. And he either does well or he doesn't. And because he's new, he's not doing well. He doesn't know how to trade. I'm teaching him how to trade. So for folks that are asking, that's where he's at. So anyway, there's the details. Everything was here. Now watch. If I go to a chart like Dixie and go back to ES, everything is virgin again. And there it is. I do that all the time because I know if it's possible for those individuals at TradingView to watch me, they can sync up an account. Now, can they just hurry up and resync it to a new one? Whatever. But I let my son go in at random times to go in there and execute. So they don't know if the trades I'm about to take are him or me. And believe me, if they're trying to do that, they're going to be very frustrated. So that's another reason why I want to stop, in November, because I don't have to do these things anymore. It'll be something that it's entirely all him. But because I'm teaching him, I want him to do it with my account. I want to be able to watch what he does and see what he's doing. And what I do is I go and I start the account with one trade that I know is mine. And he can't reset it because he gets frustrated and he wants to reset everything. Like he wants to erase like it didn't happen. I keep telling him all the time, you have to show me what you're doing, because I can't fix the things that you have as problems until I see the errors that you're doing it. So there it is. I don't need to do your funded account challenges. None of them are hard. They're very easy. And I don't need to have 5 days or minimum days. I can do it all. I can do twice. Okay. 3 times what you have to do to get funded. I can do that all in one day with one account, no copying, nothing, and do it flawlessly with no losing trades. So there's my answer to the people who keep asking me for it. This is exactly what you would have seen with a Top Step funded account or anybody else out there if it was me driving it. So please, with all due respect, stop asking me to do Mickey Mouse stuff, because I'm not interested in that. I don't need to do that kind of stuff. I'm calling the market. When I'm out there live, it's dancing for me. And when it isn't, and I can't do it because it's either being too fickle, and I'm not trying to do two to three handle moves, because you're all going to be like, well, that's the thing I want to learn. That's a very hard thing to do, because you don't know when to stop when you can do that. If you're new, high frequency trading is something that a new trader should not be aspiring to do, because you have to be able to navigate. I mean, look at this, folks. Look at that chart right there. Okay, that's a chart that's completely devoid of any kind of annotation. When you first start trading, this is what it looks like to you, and it looks like a foreign language. You have no idea. Where do you refer to? What's the information you're supposed to pull from it? The concepts that I'm teaching you help you navigate time and price. Everything there is really presented in a way that's logical. It's presented in a manner where it repeats. The phenomenon is not limited to just right now and only never repeats in the future. It's something that repeats all the time. So go back and listen to what I mentioned, or read rather, what I put on Twitter today. Look at the executions that I was doing. Everything matches here, folks. Everything on TradingView, and TradingView, they follow me. They can see if what I'm saying here is fake or lying. They're welcome to come out publicly and say it's not true. Everything here is exactly as it was. Period. I have 2 lectures that will be presented to you, one on Saturday and one on Sunday. The lectures will be individually titled. The first one will be New Week Opening Gap. It'll be my installment to the YouTube channel for 2023 mentorship. My introductory lesson and the lessons around New Week Opening Gap that I want you to have going forward. And then on Sunday, it will be New Day Opening Gap. So I promise they won't be terribly long, but permit me to have the details included. The things I want to teach you, I want you to learn it, right? I don't want to just show you a magic trick and say, oh, no, I know something you don't know. Haha. I could do that for a long time. I did, but I want to teach. So if I'm going to teach it, you should be willing to sit down and take all the information in. Okay, pull it in, make it yours. That way it means something to you. It resonates with you, not just simply watching me perform magic tricks and think, well, that was nice, but I won't use that. The things I'm using here, did you see me do much of intraday fair value gap work today? What was I using? Premium discount, time and price, liquidity, and I was predominantly using New Week Opening Gap, specifically the March 5th New Week Opening Gap, and the New Day Opening Gap that formed on Wednesday at 6 p.m. That's over here. Right there. And look at how the market behaves in there. And you're looking at this price action, you're probably thinking, oh man, this is choppy, sloppy. I'm trying to explain to you that even in those days, I can do these types of trades all day long. This is what 1990s trading was like. You don't want to trade like this. And I don't want to teach you to operate in that, because it takes a lot of patience and it takes a lot of discipline to know what you're doing. And you don't know that as a new trader under my wing. You don't know that if you are trading with VWAP and market profile and Elliott wave and supply and demand and harmonic stuff. You're not gonna be able to do well in this, because you're trying to force your pattern, your thing. When the market's going to not respect any of that stuff, it's going to do exactly what I'm talking about, because what I'm teaching you is the market. It's the source code for the market. It's up to you whether you want to believe that or not. I don't personally care if you do or don't. I'm here teaching the people that are prepared to learn. I'm not trying to convince anybody anymore. I don't care. If you don't believe me, I don't care. I really don't care. But the things that people ask me to do, or whatever I do for them, it's always going to be something bigger that they want me to do. Like, let's see if he can get to do this, and let me see if he can do that. I'm not doing that anymore. You try to do what I do. You try to do as much as I do for free, as precise as I do, and I would like to watch that. Give me something to watch, because I've been doing a lot, and I'm an old man now, and I'm trying to retire, leave you all as a community with something that you don't deserve, frankly, but I want to gift it to you. I want to give it to you and wish you well with it. And I know if you learn it, you'll do exceedingly well. A lot of my students are coming out publicly, and you're seeing their fruits. And I'm so blessed and so honored to have so many of them doing that. And I have a whole lot more that are not willing to show their face. I have a whole lot more that don't want to have any notoriety. They're just doing their thing, and they're doing really well. I have more interviews coming up. I've been away, taking some personal time off while the market was being fickle. And hopefully we're turning the corner, and we're getting into a little bit more volatility that is favorable for me to teach you intraday price action. So hopefully you found this one insightful. If you made it your entire way through this video and lecture. Congratulations, you're probably equipped to learn from me if you're new and this is the first time you've watched me. Until I talk to you next time, be safe.